Okay, so good evening, guys. Today we'll continue from where we stopped in our last class, and what we have in our scheme is transition and break of structure, application of transition, POIs and its application. We have confluence trading and retest, and also we'll be looking at our strategy, which is the BBR strategy. So as usual, at the end of the presentation, if you have any question, kindly make sure you do so well to note them down. When I'm done presenting, I will give room for question and answer. After that, we call it a day. So before now, or in our last class, we were able to look at the complexity of market structure, and we agreed that when you say a market is bullish, there are some characteristics that you really need to acquaint yourself with, which is one, the ability of the market to break structure to the upward side, and also the ability of the market to create series of higher highs and higher low. And when you say a market is bearish, you also have to tell us that the reason why this market is bearish is because you have been able to see that this market is creating series of lower lows and lower high, and also you have identified a continuous break of structure to the downward direction. Having said that, we look forward to identify our swing highs and swing low, which we agree that between a higher high and a higher low in a bullish market, we have swing points, that every major turning point in the market is referred to as what? A swing point. And same thing in a bearish market, between a lower low and a lower high, we also have swing points. And then we talked about range and also the importance of range. We're able to identify that range is the distance between a higher high and a higher low in a bearish market, and also it is the distance between a lower low and a lower high. Sorry, range is the distance between a higher high and a higher low in a bullish market, and it is the distance between the lower low and the lower high in a bearish market. We also were able to identify the move that can be referred to as an impulsive move, and the one that can be referred to as a corrective move, because that brings us to what we talked about as expectational order flow. That when you meet the market, what phase is the market? Is the market in the face of a pullback, which is also known as a corrective move, or the market is in the face of an impulsive move? Okay, so those are the things that we've been able to cover. So today to we are going to discuss transition. So what do I mean by transition? Just like the name implies, transition is just a change in phase in a market. Okay, if you have a particular market that you say the market is actually a bearish market having a characteristic such as this, of course, before you agree that this market is actually a bearish market, you can see that the market is trending toward the downside. Not just that, you see a continuous break of structure to the downside, and also creating series of a high, a low, a lower high, lower low, lower lows and lower high. So that is that about that. Now, our major focus is when the market is when the market is creating this series of lower lows and lower high, lower lows and lower high. At one point, do we know that this market want to change from either creating a lower low to create a lower high, or at what point are we going to, how do we be able to find out when the market wants to stop an impulsive move and continue a corrective move, or when the market wants to stop a corrective move and continue an impulsive move? So like I said, transition is what helps us to know that there is a change in phase in the market. So where are we going to identify this point of transition? Remember, if I'm saying that this market is bullish, I'm indirectly saying that I am on the higher time frame perspective. So the market I'm describing here being a bearish market, is on the daily time frame or H4 4-hour time frame, as the case may be. So I'm saying that this market I'm describing here is assumed to be on a higher time frame market structure. All right. So at this at every turning point, at every swing, last week we were able to look at swing points and range. At every swing point or every swing highs or swing low in the market, transition occur. Where are the swing points we have here? These are various swing points. This is a swing point here. This is another swing point. Okay, so this is another swing point here. So all of these points you're seeing here, they are actually called swing. This is swing high, and then this is swing low. Okay, so when I say turning point, this is what I refer to. This is what I mean by turning point in the market. So at every point here, these are swing high, swing high, swing high. These are swing low, swing low, swing low, swing low. So at every swing point, as every swing highs and swing low, transition occur. It is transition that will help you to know that okay, this market is about to take or is about to change phase from either being bearish for a particular period of time to a bullish phase. So when you look at this point on the daily, if you scale down to the lower time frame, this is what you are going to see. I'm going to analyze this particular point. Let me expand this one so that you know the one I'm looking at. I want to look at what happened at this phase in the market. All right. Now, when you go to the lower time frame, remember I said this is the daily time frame. When you come to the lower time frame, this is what you are going to see. You are going to see something like this because you see the market creating substructure like this. So this is what you are going to see. This particular point I circle, when you come down to the lower time frame, let's say 5 minutes. Let's assume this particular phase is 5 minutes. This is what you are going to see. Now, when you see transition happen, is this particular phase is a pullback phase, but you want to know when this pullback will stop and start the impulsive move. That's why you see the market initially. This pullback will be in form of substructure or a kind of a bullish move on the lower time frame. That's why sometimes you might see that on the higher time frame the market is bearish, but when you come to the lower time frame it will look like the market is bullish. The reason why you are seeing it that way is because what the bullishness you are seeing on the lower time frame is actually a pullback for a continuation on the higher time frame. So you see the market creating series of a low, a high, a higher low, higher high, higher low, higher high. Then it will get to a point, this pivot point, and what you will see is that either the market will create something like this and causes a change of character. This is what we call change of character. Okay, this is what we call change of character. What happened here? Why do I say so? You see, the market was creating series of higher high, higher low, higher high, higher low, higher high, higher low, higher high. Remember the characteristic of a bullish market is that it must be creating series of higher highs and higher lows, and there must be a continuous break of structure to the upward side. Now, when you look at what happened here, we expect that the market is supposed to create a higher low and then push to the upward side to create a new higher high. But what happened is that the market break down to take away the previous higher low. So that is the first thing. Immediately the market break and take away the previous higher low. What we said, we can say that what happened here is called a change of character. So this is what choch look like. So the importance of this thing is when you are holding a trade for a long time, when you are holding a trade for a long time, transition will help you to know that okay, it is possible that this market want to start reversing, because every reversal in the market starts with transition. That is an important point you should note. Every reversal in the market starts with transition from the lower time frame down to the higher time frame. I could remember in one of our class we talked about the fractal nature of market price and structure, where we said that whatever happen on the higher time frame replicates itself on the lower time frame. Before you can notice a transition on the higher time frame, it must have happened on the lower time frame. That is why as a trader, you really need to be very flexible when you are operating in the market so that you can, be able to make a good deduction from market behavior. So if you are holding this particular market, maybe you decided to take a buy, and then you come down to the lower time frame and you have been able to see that okay, the market has changed character. That is an indication that it is possible that this market want to continue selling back. So this is another way you can decide to like, okay, I think I could no longer hold on to this trade. Let me just close. So this is another way you can be able to do that. I hope that is taken. I hope that is taken. So I will just take you through the chart, or this is a case of a bearish scenario. Now let's look at a case of a bullish market so that I will just look at the live chart application of it. So in a case of a bullish scenario, you have something like this. You see the market in a bullish move like this. So you actually want to understand what happened around here. Okay, you want to understand what happened around here. And how you do that, when you come to the lower time frame, what you will see here is that the markets will be creating a substructure of this kind, and then all of a sudden you see that change of character around here. This is where the change of character occur. So another important thing I want to note is that before you can consider a change of character, you have to properly identify which phase or what is the market actually doing. For instance, in this scenario, the market was selling on this particular time frame because we are assuming that this is the lower time frame. Now, when the market is selling, it is creating what? Lower lows and lower high. Now, this was the previous lower high before this lower low. Now, after a lower low, we expect that the market to create a new lower high and then a new lower low. But instead of doing that, the market decided to violate the characteristic nature of a bearish market by through breaking a structure to the upward side, which is against the characteristic of a bearish market. And so the moment that previous lower the moment that previous lower high was taken, we say that the market has changed character. So that is that about change of character. So and transition in the market. Now let's look at the live chart application of it. Let me go to the 4 hour to check what this market is doing. Okay, so this is the 4 hour time frame of this particular chart. I believe you can hear me. I need a response.
Yes, yes.
Okay, okay. So this is the 4 hour time frame of this particular chart. Now, if you notice, this market is actually bearish. All right, this market is actually bearish. Now, how do we know that the market is bearish? We can see the market creating series of lower lows and lower high around this region. But this is from this point, the market was actually bullish around this level, but The moment this particular phase, this is a higher low and a higher high, we expect that the market will create a new higher low and a new higher high, but instead the market break down and you see the market start creating substructure. The market start creating a new structure of bearishness to the downside, creating series of lower low, lower high, lower low, lower high, lower low, lower high, lower low, lower high. Sorry, this is a lower low, this is a lower high, and then this is a what currently the market has just created an impulsive move for a new um lower low. Our interest is what happened around this region here. When a market is creating, because your aim of trying to study the higher time frame structure is to note what the market will do. The aim is for you to understand where the market is trending to and then to find entry in alignment with that particular trend. Now that we have identified that the market is bearish, in a situation where you see that the market is pulling up, how do we find a good area of entry to continue with the market? Or how are we going to find out that this pullback, because this move between here and here is just a pullback, all right? Now, how do we know that this pullback is about to come to an end and the market is about to continue moving in its original trend? So when you come down to the 15-minute time frame, look at the 15 minutes here. You see that tiny place? You see that tiny place I marked? This is just it. Now look at what the market is doing. This particular pullback happened in form of a bullish market. How do I know? You see the market made a change of character around this level. Around this level, the market came down to this point, created a lower high and a lower low, and then you see the market break out at this point. Around this region, there is a change of character, and the market was creating series of higher highs and higher low, higher highs and higher low, higher highs and higher high, higher low, higher high. Now, look at what the market did. Immediately after this higher high was created, the market changed character by breaking this structure here. By breaking this structure here. So this is what I mean by change of character. Sure. See, the market break out of this point, and I have to be patient enough to see that okay, if this market create a lower high and a new lower low, then I'm convinced that the market has completely changed from being a bullish market on this particular phase to a bearish market. And if you notice, the market created a lower high and a new lower low, and since then what you are seeing is what? A lower high, lower low, lower high, lower low. So currently the market has created a lower low. We are expecting a push to the upside, and then the market should do something like this. So this is what we are expecting. So this is how transition will help you. If you look at this particular phase I circle as well, the same thing happens. Between this region, the market pulled back to creating substructure to this particular point. But immediately after this after this higher low and this higher high, the market created something like this. It created a potential lower low, which we assume that after this guy, the market will create a break of structure to the upward side, but then the market break down to take away this guy. Immediately this level was broken, we see that the market has changed character. So this is the area where transition occurred. That is my point. This is the area where transition occurred. And you have seen that transition will help you to know when a market wants to change direction. When the market is bullish, and suddenly you notice that transition is happening on a particular time frame, it is an indication telling you that it is possible that the market want to actually start a new move in the market. Okay, so I hope that is taken. The next thing I want us to talk about is POI. Okay, next thing I want us to look at is POI. Now, what is POI? POI basically means point of interest. Okay, that is just what POI stands for. POI basically means point of interest. When you identify the trend of a particular market from a higher time frame perspective. If you want to make your entry, you are not supposed, this is very important, you have to take note of it. You are not supposed to trade from anywhere in the market. There should be an area you are looking at to take trade from. That area you are looking at to take trade from is your POI. It is actually called point of interest. Some textbook may refer to it as area of value. Okay? Because when I remember when I was explaining candlestick anatomy, I told us that it is not advisable for you to trade candlestick in isolation. Why? The reason is because the type of candles that you have read about can appear at any point in time on the market. But the best place to take those entry from or to apply those candles is if you find them on your POI, which is what point of interest. For instance, if you have a market, let's assume that this particular market is bearish, for you to have a good area where you want to make an entry from, you are not supposed to just take your entry from any point in the market, because when you have something like this, you are supposed to look at a potential area where you feel like, okay, if this market comes to this level, there must be a reversal, and those POI are always your support and resistance level. Because I'm going to consider this point as my POI one. I will also consider this level as my POI. So what happened is that in a case where I notice that there's a push to this point, I may decide to take an entry from this particular level here and ride the market all the way down, because this point now has become my POI. This particular point has become my POI. Okay? It's also possible that the market can decide to push from here all the way to this point and begin to crash down. So this point is also my POI, and I'm willing to take entry from any of this level. So for instance, if you are, for those of you who have already been in the signal group, whenever I'm sending a signal and you notice that I have like maybe 2 or 3 resistance zone, because these are all resistance and support levels. If you have any of these things, it's an indication telling you that the market can reverse or make a reaction from any of this level. Because one fundamental truth about trading is that it is a game of probability, and you never can tell, no matter how good an analyst you are, you can never predict what the market will do accurately. You are only trying to work with probabilistic mindset that, okay, it's possible that the market might come to this level and reverse to the upward side, or the market can come to this particular level and reverse to the downward side. Okay, so this is just what POIs will help you do. It just make sure that when you mark out your POI, which are your support and your resistance, be patient enough to wait for market to come to your level. Okay, that's about that. Now when you look at this chart, okay, when you look at this chart, if I've already seen from the higher time frame perspective that this market is actually a bearish market, so I should be looking for where to take an entry for a sell, right? Now I have to mark out my POI. Most times it is advisable that you mark your POI from a higher time frame perspective, because the support and resistance of a daily time frame is very much significant than support and resistance of a higher time frame. So make sure that when you want to mark your POI, you can try as much as you can to go to a higher time frame, probably maybe 1 hour. Like you should be taking your entry from 1 hour support, H4, like daily time frame support. Those are support level that are very very strong, or resistance level that are very very strong. But just to portray my point, I will just have to mark out this level. Now you can see that the market is actually retracing to the upward side. So what I will do is I will look for possible area where I think the market can reverse from. Now I'm looking at this particular place. I'm looking at this particular place. So all of these places I'm marking right now, they are serving as my POI. Okay, they are serving as my POI. Now when I'm finished marking out all of this level, the next thing I want to pay close attention to is what? Reaction from those levels. Now when the market pull up to my POI, I will not just quickly open my MT5 and start selling or start buying as the case may be. I will have to be patient enough to wait for confirmation candle. Okay, I have to be patient enough to wait for confirmation candle. So that is why for those of you who are in the signal group, you will hear me say something like wait for the 15 minutes candle to close. If the market close as a bearish candle or as a rejection candle, you should make your entry. All of these things are just confluence that I add before making entry. When the market comes to your POI, you now have to start looking out for your entry. So basically, the summary of what you should know when you are doing analysis is number one. The first thing is actually looking at the time frame you find yourself in the market. Am I on the higher time frame? If you are not on the higher time frame, switch to the higher time frame. When you are on the higher time frame, check for what the market is doing on the higher time frame. Is the market bearish on the higher time frame or the market is bullish on the higher time frame? If the market is irrespective of what the market is doing, either bullish or bearish, you want to make every trading decision in alignment with what the market is doing on the higher time frame. Having said that, the next thing you want to do is mark out your POI, identify your range, identify your recent market range. Once you have been able to identify that, the next thing is mark out your POI. Where do you think that if this market comes to this level, what do you think will happen? Will the market begin to sell from there or the market will begin to buy from there? So the moment you have been able to mark out those points, the next thing you want to do is exercise patience on the lower time frame for this market to come down or come up to this your POI and give you a candle reaction before you make your trading decision. So that is that about how you can actually apply how you can actually apply POI transition on your analysis. Okay, I hope that is taken. So as it stands now, this market is actually on this particular level. When you have multiple POIs like this, what you are saying in essence is if the reaction does not happen here, it will happen here. If it doesn't happen here, it will happen here. So as a trader, what you just need to do or how to position yourself in that situation is wait for when the market come down there. For instance, look at this candle have closed on the 5 minutes. This is not the type of candle I want to see before making an entry for a sell. So what will happen is I will neglect this particular zone and allow this market to come to this level. If the market come to this level and give me the kind of reaction that I'm looking for, of course I'm going to take a sell. And if it doesn't, I'll actually wait. But if it doesn't give me reaction from here, then I'll allow the market to do whatever you want to do. I'll switch to other time frame to look for other entry reason. So that is that about what we have for today. The next thing I actually want to talk about is our strategy, but I think I'm going to leave it for our next class. So try as much as you can to assimilate what we have discussed here today. And I believe that with all of these things that we have discussed so far, you should have been in a position to do good analysis at this point in time if there is any mistake, because practice make perfect as the saying goes. So that's that about that, guys. And don't forget to always try as much as you can to visit the channel so that you can watch as many educative videos as you can, especially the videos that talk about technical analysis. You see the title as how to do analysis on your PC, how to do analysis on your mobile phone, how to do a top-down analysis. All of those things are what are videos that you should pay attention to. And I believe that as you do that, you are definitely going to see improvement. So that's that about what we have today. See you in our next class.